7 days. That might be all the time left before a decision from the Federal Reserve that could rewrite the future of global markets, possibly launching gold toward a target many believed was impossible just a year ago. A price point that analysts at institutions like JPMorgan are now openly discussing, $5,000 per ounce. Not someday, not decades away, in this cycle. And the reason behind this radical forecast isn't hype or speculation. It's data, it's behavior, it's institutional positioning. And most importantly, it's something happening quietly beneath the surface that has gone almost entirely unnoticed by the general public. Once you see it, the 5,000 prediction stops sounding aggressive and starts looking conservative. But before we uncover that hidden factor, we need to understand the moment we're in right now. Because the Federal Reserve is standing inside what many market historians describe as an economic minefield. A single misstep could trigger a financial chain reaction that forces gold into the biggest breakout in modern history. Wednesday, 2 p.m. Eastern. The Federal Reserve rate decision. Every camera pointed at Jerome Powell, every analyst on edge, and billions of dollars preparing to move in seconds. This video is not financial advice. It's purely educational commentary based on publicly available information. And what's publicly available right now paints a picture many would call unprecedented. The Fed is trapped, not cornered, not pressured. Trapped. Inflation is still running above their target level based on recent readings, refusing to come down to 2%. Meanwhile, new economic data suggests unemployment could be weakening faster than at any point since around 2008. Companies are cutting workers. Growth is slowing. The foundation is cracking. The Fed has two choices. Both are dangerous. Cut rates and risk lighting inflation on fire again. Or hold rates and risk breaking the job market completely. There is no clean option. Only consequences, and markets know it. That's why gold has surged dramatically this year, climbing roughly 60% in what analysts now describe as one of the strongest annual performances in decades. And historically, when gold begins a run like this, it rarely stops early, because precious metal bull markets are never about enthusiasm. They're about fear, distrust, and systemic instability. And we've seen this play out before. Twice, each time leading to explosive gains far beyond what anyone predicted. First example, August 1971. President Nixon closes the gold window, ending the convertibility of the dollar into gold. Overnight, the dollar becomes backed by nothing but political promises. Gold trades around 35 per ounce. Then the world wakes up. By 1980, gold reaches approximately 850. A gain of over 400%, not because gold became more valuable, but because confidence collapsed. Example 2, 2001. Gold trades around 270 per ounce. Nobody cares. The world is obsessed with technology stocks, with growth narratives, with cheap credit. Then the Federal Reserve slashes rates aggressively, liquidity surges, the housing bubble forms, and in 2008 the system implodes. By 2011, gold reaches nearly 900, roughly 700% higher. Every time trust in fiat money evaporates, gold becomes the emergency exit. Now here's the shocking part. Analysts say the current environment may combine both of those historical triggers simultaneously, massive debt stress and accelerating global de-dollarization. And that combination could dwarf the returns seen in either period. Right now, gold trades around 4,200. Many analysts argue that if it breaks through key technical levels after Wednesday's announcement, momentum could take it straight toward 4,500, 4,700, even 5,000. And once it clears that psychological wall, institutions could stampede into the market. Which brings us to the most critical part of the story. Something that has been happening quietly for over a year. Something almost no mainstream outlet is talking about. Something that might explain why JPMorgan, Goldman, and others are predicting such aggressive upside. Because this isn't speculation anymore. This looks like preparation. And in the next segment, we're going to dig into that hidden force, the behavior of central banks, the silent shift in global reserves, and the warning sign that could mean the 5,000 gold forecast isn't just possible, it may already be underway. So let's uncover the force driving this silent financial earthquake. Because while retail investors debate price targets and argue online, the most powerful financial entities on the planet appear to be preparing for something much larger than a routine rate cycle. For approximately 13 consecutive months, central banks around the world have reportedly been buying gold relentlessly, month after month, without a single interruption. Not a spike, not a trend, a sustained accumulation streak that industry analysts describe as one of the strongest official buying events in modern financial history. Why would major nations suddenly start converting reserves into gold? Why now? Look at the list. China, Turkey, Poland, India, a growing coalition of countries increasing their reserves aggressively. According to public estimates, China's holdings now exceed roughly 74 million troy ounces, valued at more than $300 billion at current prices. And that number appears to keep climbing. China isn't doing this by accident. They're doing it with intention, precision, strategy, because they understand what's coming. Foreign central banks appear to be reducing their exposure to U.S. treasuries while increasing allocations to hard assets. And this shift is not ideological. It's mathematical. The U.S. national debt has exploded to approximately $38 trillion, up about $2 trillion in just 1 year. The Congressional Budget Office projects annual deficits around $2 trillion into the foreseeable future. That means more borrowing, more printing, and more pressure on the dollar. And here's the uncomfortable truth: faith in the dollar may be eroding far faster than most realize. The global financial system runs on trust, and the world is beginning to question whether the United States can sustain its debt without permanently weakening its currency. So where do central banks go when confidence fades? They move into something that has survived empires, wars, currency resets, and political chaos for nearly 5,000 years. Something no government can print. They move into gold. This isn't diversification. This looks like preparation for a new monetary framework, a repositioning for a world where the dollar may no longer have uncontested dominance, and the timing is not random. It aligns perfectly with the Federal Reserve reaching the breaking point, because the Fed's next move could reveal how fragile the current system really is. 5 days ago, something else major reportedly changed. The Federal Reserve ended quantitative tightening, the process of shrinking its balance sheet and reducing liquidity. For nearly 2 years, they have been draining money from the system to battle inflation. And then suddenly, without major announcement or media focus, they stopped. If they follow that shift with a rate cut this Wednesday, they won't just be easing. They will be reversing policy direction completely. More liquidity, cheaper money, market fuel. Historically, every time the Fed has pivoted from tightening to easing, gold has rallied, and not slightly, strongly. Because the pivot signals one thing: the system can no longer handle stress. Inside JPMorgan's latest commentary, analysts highlight the increasing probability that gold could reach $5,000 within this cycle. Goldman Sachs estimates potential upside toward $4,900. Other institutions are posting targets around $5,000 by 2030. And when global giants publicly align on the same trajectory, it usually means their clients already want exposure. But price forecasts miss the most explosive factor of all: the multiplier effect. Because gold isn't the only thing that moves in these cycles. Gold mining companies historically act as leverage exposure, rising 2 to 3 times faster than gold itself. Recent sector reports suggest mining stocks are up roughly 125% this year alone, double the movement of gold, and their profit margins are widening dramatically. Estimated cost to mine an ounce of gold is around $1,600. With gold trading near $4,200, miners are capturing about $2,600 of profit per ounce, among the highest margins in modern history. And instead of wasting the cash like previous cycles, they're paying down debt, increasing dividends, and buying back shares. If gold reaches $5,000, that margin could explode. And historically, when margins expand and investors rush in simultaneously, mining stocks can go parabolic. That's why institutional players may be positioning now, before the Fed meeting, before the breakout, before the public wakes up. Because once gold potentially breaks through 4,264 and pushes toward new all-time highs near 4,381, price becomes psychological. It becomes fear of missing out. It becomes a stampede. And if the Fed announces a cut, or even hints strongly at more cuts coming, momentum could ignite instantly. In the next segment, we're going deeper into the scenario analysts call the monetary endgame: what happens if the global dollar system weakens further, why gold might become the core of a new currency standard, and what this means for the next 12 months. So let's confront the question everyone is quietly asking, but few are willing to say out loud: what if this isn't just another market cycle? What if this isn't simply a bullish phase for gold? What if we're witnessing the early stages of a monetary restructuring? The kind that only happens once in a generation. Because the forces building right now aren't temporary. They aren't emotional. They aren't speculative. They are structural. And history shows that when structural pressure meets policy instability, the result is never gradual. It's sudden, violent, irreversible. Picture the current environment. The United States government continues to run trillion-dollar deficits year after year. The total national debt climbs past $38 trillion with no realistic plan to slow it. Interest payments alone are approaching levels that exceed defense spending. Foreign buyers of U.S. debt appear to be stepping back, and the Federal Reserve is being forced into a corner surrounded by rising inflation pressure, weakening employment, slowing growth, and political turbulence. Add to that a divided Federal Open Market Committee, where analysts expect multiple dissenting votes during Wednesday's rate decision, something rarely seen since the early 1990s. When policymakers disagree publicly, the illusion of control breaks. And once confidence cracks, markets behave differently. Meanwhile, central banks across the world are shifting reserves toward gold, accumulating more than 1,000 tons annually according to industry estimates. They're not waiting to see what happens. They're preparing for what they believe is already coming. And against this backdrop stands gold, trading near 4,200, testing resistance zones that traders say could trigger one of the most aggressive upside movements in history. If the price breaks through the upper band around 4,264 after the Federal Reserve announcement and pushes past 4,381, there may be little resistance until 4,700 or even 5,000. And once that level is approached, the market will no longer be driven by analysis. It will be driven by psychology. Nobody wants to be the last one to act, especially not institutions whose reputations depend on performance rankings. And that's why JPMorgan's warning is being taken seriously. Their forecast suggests a scenario where gold hits $5,000 within this cycle, potentially by 2026, driven by a convergence of factors that haven't aligned like this in modern history: debt stress, inflation resilience, weakening currencies, geopolitical instability, energy volatility, slowing global growth, and now a Federal Reserve on the edge of reversing tightening. Once the pivot becomes undeniable, everything accelerates. That's when investors flood in. That's when retirement funds rebalance portfolios. That's when sovereign wealth funds move. That's when mining stocks begin multi-year expansions. And that's when the narrative changes from skepticism to certainty. Think about the pattern. When gold was around 1,800 in 2022, experts said too expensive. When it crossed 3,000 in 2024, they called it irrational. When it punched toward 4,000, they called it a bubble. And now at roughly 4,200, many still believe it's temporary. But major financial institutions don't appear to believe that. They're accumulating. Central banks don't appear to believe that. They're buying. China doesn't believe that. They're stacking gold month after month without pause. The market is shifting. The world is shifting. And the question becomes unavoidable. Do you want to watch it happen or prepare for it? Because Wednesday's decision may be the spark. If Powell signals softness, if he opens the door to cuts, if he acknowledges economic strain, gold could move instantly. If he attempts to sound strong and hawkish, the price may dip briefly. But the structural forces suggest long-term direction remains upward. The Federal Reserve can delay the pressure. They cannot eliminate it. Debt doesn't disappear. Trust doesn't rebuild quickly. And once global institutions commit to a new strategy, they rarely reverse it. That's why many analysts describe the 5,000 gold forecast not as a dream, but as a destination already on the map. Everything is pointing toward it: capital flows, policy turns, global repositioning, historical pattern, widening mining margins, and the most aggressive central bank accumulation in modern history. And we are days away from a moment that could decide how fast we get there. Wednesday, 2 p.m. Eastern. Cameras live. Jerome Powell steps to the podium. The world waits. What he says next may determine not only where gold goes in the short term, but how the global system evolves in the years ahead. If you found this analysis valuable, subscribe right now, because the next video breaks down exactly what Powell might say, the 3 market reactions that could follow instantly, and how investors are positioning in advance. The $5,000 in gold forecast is not hype. It's a warning. It's a signal. It's a potential turning point in financial history. And we may already be living in the first chapter.